Good morning, this is Robert Kaars Sijpesteijn bringing you this morning's market update. Looking at US markets, indices dragged and dipped due to the negative sentiment and disappointment following Mario Draghi's speech yesterday. The ECB's move triggered a spike in the euro that caught investors off guard and caused a large shift in positions which hit most asset classes. The US 500 shed 29 points to close on 2054.28. The US Tech 100 lost 82 points to close on 4,614.27, and the Wall Street dropped 254 points to close on 17,511. Following the disappointment of Draghi, Fed Chair Janet Yellen reiterated her upbeat take on the US economy's outlook, signaling that conditions were getting ripe for the first lift in short-term interest rates since 2006, as she emphasized the strength of the domestic economy even in the context of weaker performances abroad. The Fed faces a pivotal meeting in 2 weeks' time, with markets now firmly expecting its policymakers will lift short-term rates. Ms. Yellen has been treading a fine line between priming markets for an upward move in the near future and making it clear that subsequent increases will follow a shallow trajectory. The Fed chair was speaking ahead of today's jobs figures that will be closely watched going into the December 15-16 meeting. Ms. Yellen said that payrolls data were important and that she wanted to continue to see a solid trend in job creation, but she also insisted that Fed does not put too much weight into any single number. Moving to commodities, gold rallied $10 up to $1,063, and likewise Brent crude added value, gaining $1.40 to close on $44.03 a barrel. OPEC looked on track to maintain the status quo after member states clashed over oil production policy at an unusual informal gathering before the group's official meeting in Vienna on Friday. Saudi Arabia held its line on Thursday, insisting other big producers outside the group, such as Russia, would have to join any output cuts by the Organization of Petroleum Exporting Countries. With oil prices hovering near a 6-year low, cash-strapped countries including Venezuela, Ecuador and Algeria are pressuring Saudi Arabia to cut production. A year ago, Riyadh spearheaded a decision to maintain output and fight for market share rather than cut production to sustain high oil prices. The move helped to send Brent crude, the global benchmark, down to $42 a barrel from near $100, and the Saudis, the world's largest exporters, have stuck with their one-year-old view that any output cuts won't work unless big producers outside OPEC, including Russia and Mexico, participate. If prices recover sharply, it could revive some US shale production, displacing OPEC's crude. Russia, Mexico and other big producers outside OPEC have given no indication that they'd agree to any OPEC-led output cuts. Russian Energy Minister Alexander Novak said on Thursday that the country doesn't see a production cut as viable, leading to no signs of a sharp rise in oil prices in the near future. Looking at Europe, the Germany 30, which looked set for an early Santa rally, slumped yesterday off the back of highly disappointing news from Mario Draghi. The index slumped a total of 433.6 points to 10,690.8. After months of talking up extra stimulus, Draghi cut the interest rate paid on deposits kept at the European Central Bank to minus 0.3% compared with expectations of minus 0.4%. The landmark asset purchase program was extended just another 6 months at the same monthly rate, whilst many were expecting on a 12-month extension and a higher rate of purchases. The asset purchase program will now run until the end of March 2017 instead of September 2016 as initially planned, but will stay at a monthly rate of 60 billion euros. It will take the value of the program up to 1.5 trillion euros from 1.1 trillion, and the ECB has also added regional government bonds to the list of assets it can now buy. The UK 100 also suffered, losing 158 points to close on 6,230.8, and miners were some of the biggest losers, with Glencore, Rio Tinto and Antofagasta dropping 3.51%, 3.4% and 2.62% respectively, setting the precedent for a negative day in the UK. In corporate news, Uber Technologies is looking to raise up to $2.1 billion in a financing round that would value the car booking company at $62.5 billion. The new funding shows Uber is accelerating its race to expand globally and branch into services beyond picking up and dropping off riders. The company has tested food and package delivery in some cities and is working on new technologies such as self-driving cars. Uber is spending aggressively to expand throughout Asia, particularly in China, where the company expects to spend $1 billion. Ladbrokes has appointed John Kelly chairman of the company, and he will take up the role immediately. And Easyjet passengers numbers were up 9.6% in November compared to a year ago, despite a higher number of cancellations. Today's economic data in focus: at 1:30 we have the US unemployment rate released along with non-farm payrolls. That's all for this morning's market update. Thank you and goodbye.